My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So, today I wanted to talk about inherited property and the tax treatment of inherited property. I got a few questions about that. And on an unrelated video, I think I was talking about depreciation on rental properties, but I had got a few questions about how you actually treat inherited property. Do you depreciate it when you get it? What's the tax implications of receiving it? So I figured I'd share a few pointers here. The beautiful thing about inherited property, especially with real estate, is that the person that inherits the property, their cost basis is what's called a stepped up cost basis. And the reason why that's important and why that helps you out in terms of taxes is that your cost basis determines, if you were to go ahead and sell that property, the number that you would use to calculate any gain or loss on the sale. So when you receive the property through an inheritance, that's tax free. So that's great. You don't pay any taxes on actually receiving the property. It just becomes a question once you go ahead and say sell the property. So there are a couple factors that come into play as far as the tax treatment if you were to sell a property that you had inherited. So going back to the cost basis, the cost or the number that you use to determine whether there was a gain or loss on the sale is your cost basis. And the beautiful thing is your cost basis becomes the fair market value at the time you receive the property. So if you had to put that in context or use some examples, if you inherited property or house from your parents and your parent purchased the home for 100,000, but by the time they passed away, you inherited it, it was 300,000. So your cost basis now is that 300,000 and not the 100,000. So let's say you then hold on to that property for some time after you inherit it and then you sell it. Let's say you sell it for 600,000, right? So your cost basis, or what it is you need to determine whether there was a gain or loss, is actually the 300,000 rather versus the 100,000, even though your parents way back when only paid 100,000 for it. So if you were to pay taxes on that property, it would really be the difference between the 300,000 and the 600,000 and not the initial 100,000. So that's great because it's gifting or passing properties through inheritance. It's a great way to avoid tax on the appreciation that might have happened over time. Now, let's say you do hold on to the property and go ahead and sell the property. Now, depending upon what you did with the property will determine what the tax treatment is going to be, right? So if you were to inherit their property and sell it right away, say, hey, I don't want anything to do with this. You sell it as soon as you inherit it, take the cash and run. In that instance, because the basis now becomes what it was worth when you inherit it and you sell it right away, there's no gain or loss. You can take the money, cash out, and it would really be of no consequence to you. But now let's say you just hold on to it and now it appreciates. You don't do anything and it's just sitting there. Then you would have to pay the tax on the difference between what the value was when you inherited, so if you were just sitting on it. Now, another way to avoid it altogether is, let's say you inherit the property, now you live in the property, and that becomes your primary residence. So in that instance, the capital gains on primary residence tax rule would come into play where you lived into the property 2 out of the last 5 years that you've owned it, you get that tax exemption on a gain of 250,000 single, 500,000 if you're married. So that could be a good strategy. Just make sure that you stay in it long enough to get that exemption. So now, if you were to take that property and turn it into a rental, get all the benefits of any deductions that you would need to have as a rental. But then if you turn around and sell it, comes capital gain, but again, based upon the difference between the value of what it was you inherited it at. So there's different treatments depending upon what you do with the property once you obtain possession of it. So have to be careful about doing any unintended consequences depending upon what you do. So you also have to take into account with the capital gains, short-term versus long-term, right? Property appreciates right away. Held the property for less than a year, then that's short-term capital gain, which are taxed at your normal rates, versus if you held the property for over a year and then sell it, then it becomes a long-term capital. And those tax treatments are more favorable. So that's another thing you want to take into consideration, the period of time that you hold on to that property between the time you inherit it and the time that you sell it. And so you just have to be mindful of that instead of creating some unintended consequences. So that's all for now. I hope this helped. If you have any more questions about this topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help.